Hello everyone, I am Dr. Sarika Makol, Associate Professor in Saga Group of Institutions, Bhopal. Today I am going to discuss about money market from the subject Security Analysis and Investment Management in MBA 3rd SEM. So we talk about money market in this. Before going further, first of all we should know about what is money market. Basically, this is one of the alternative of making investment in the stock market. This is also one of the way to make investment and to get returns over that very particular investment. So what is money market? Money market basically refers to a section of the financial market where financial instruments with high liquidity and short-term maturities are traded. High liquidity here means the instruments which can be easily or very short span of time we can convert it into cash. That instruments are known as high liquid instruments because their maturities are very short. Money market has become a component of the financial market for buying and selling of securities of short-term maturities. Now what do you mean by short-term maturities? It means of 1 year or less than 1 year, such as Treasury Bills and commercial papers. So these are the instruments of the money market which are being traded in the money market. It is basically used by many participants including companies to raise funds by selling commercial papers in the market. So these type of market is basically used by those participants or by those companies who would like to raise funds for a shorter period of time, who would like to have high liquidity in their financial instruments. So those firms or those companies may use this market to trade or to buy and sell their commercial papers or treasury bills or their securities, right? Now these are the features of money market. Basically this market is an unregulated and informal market. This is not like your stock market, which is very much organized market and regulated by SEBI guidelines. This market is an unregulated and informal market, and it is not structured like the capital market or the stock market. Money markets are different from capital markets. Capital markets here means your stock markets, as they are for a shorter period of time, whereas your stock markets and the capital markets are used for a longer period of time. Over-the-counter trading is done in the money market. Now what is over-the-counter? Over-the-counter means that on the spot buying and selling trading would be done in the money market. It is a wholesale process where you can get the commodities at a discounted rate and you can sell it at the maturity period. It is used by the participants as a way of borrowing and lending for the short-term period of time. It is considered as a safe place to invest because the high liquidity of the securities. High liquidity here means that you can easily buy and sell your securities in a short span of time. Withdrawing money from the money market is easier. Why? Because the liquidity is very high. You can anytime purchase and sell your securities. Now, what are the objectives of money market? The main objective of money market is to provide borrowers such as individual investors, government, etc. with short-term funds at a reasonable price. If any of the investor or government many a times need funds for, say for an example, for 3 months or 6 months period of time, so they can make investment in this very particular market. They can borrow the funds from this market for a shorter period of time. It also enables lenders to turn their idle funds into an effective investment, and that too for a shorter period of time they can earn returns over their idle funds. RBI regulates the money market, not the SEBI, but the RBI regulates the money market, therefore in turn helps to regulate the level of liquidity in the economy. This market maintains the liquidity in the economy also. Since most organizations are short on their working capital requirements, so all such organizations can meet their working capital requirements with the help of this money market by making investment in this very money market for the shorter period of time. It is an important source of finance for the government sector also, for both national and international trading. and hence it provides an opportunity for the banks to park their surplus funds. Even the banks can park their surplus funds for few months, for few days. This money market starts from 14 days to 1 year. As the treasury bills, the minimum time of maturity of the treasury bill is 14 days. Now, the money market instruments, treasury bills is one of the money market instrument which is known as a short-term promissory notes issued by the governments. Typical maturities of these treasury bills, as I told you, it's minimum 14 days. In 14 days, you can just mature your funds. Then 91 days, 182 days and 364 days. Means up to 1 year is this market prevails. Due to government backing, there is very low risk of default because RBI is involved in that, and government is also there because these all instruments are the government instruments. So the chances of default is very less. It is widely distributed and actively traded, and high liquidity is there in this very particular market. So these are the examples of treasury bills with the rate of interest in the market as on April 15, 2020. The 91-day treasury bill is giving you the interest rate of 4.14, 182 days 4.32, 364 days 4.38. These are the rates as on April 15, 2020. Now this is the difference between money market instruments versus stocks. On the basis of these points, maturity of the instruments, money market instrument carry a maturity period of less than 1 year, whereas stocks carries a maturity period of number of years. These financing needs, on the basis of financing needs, these instruments are used to fund the short-term needs of the borrower. As I've told you, the working capital requirements can be met with the help of these money market instruments, whereas stocks used for long-term fund requirements. Types of instruments in the money market are treasury bills, certificate of deposits, interbank call money and commercial papers. All are the government instruments. Whereas in stocks, these are the independent listed company stocks are there in the stock market. On the basis of degree of risk, risk is comparatively lower in the money market because of the high liquidity period as well as the government backing, whereas in the stock market risk is higher. So this is basically the difference between money market as well as the stock market. So I hope that you would be able to understand the basic concepts of the money market. So in my next lecture, I'll definitely tell you about other instruments of the money market.